Hello and welcome to July's edition of Finance in 15. Josh and Joe here, and as we finalize on the first 6 months of 2023, we thought it'd be a nice idea to reflect on some of the months that have gone by. In doing so, maybe we can help crystallize some key learnings and help chart a course throughout the rest of the year. Looking back on the first half of 2023, I think it's probably fair to say that the outcome has been a little bit better than expected. For both the stock and the bond market, and especially compared to the volatile 2022 that we've seen. Just to give you some perspective, the NASDAQ is up 32% year to date. Now, given it was down over 30% last year, but still, I think it was pretty surprising to see, and mostly led by the big tech stocks. The S&P 500 has been up about 16.5% year to date, followed by the international stock markets that have been up about 11.5%. And the bond market has been up about 1.5%, but again, perspective with the bond market being down almost 15% last year, which is highly abnormal. It's been significantly more stable. So what are some of the points that we've learned thus far through the first half of the year? Well, first, inflation's path is not endlessly higher. The return to some, let's call it post-COVID-19 supply-demand normalcy and ease in input costs have helped push inflation down. And that's helped both the stock and the bond market bounce back a fair amount. We've also seen some strong consumer spending and a stubbornly tight job market. I know, Joe, you'll talk about both of those things shortly here. And that's really helped the U.S. avert a recession so far. The Federal Reserve continues to raise interest rates, and although they've taken a temporary pause, we do believe that they will continue to raise rates, whether it's the start of this year or at least, towards the end of this year, Q4 2023, or perhaps Q1 2024. And lastly, bonds look like bonds again. And after enduring a period of weakness in 2022, bonds are back and should still significantly be considered a part of a multi-asset balanced portfolio. So Joe, let me turn it over to you and maybe you can dive a little bit deeper into some of those concepts.
Yeah, so thanks for covering the indexes and some of our key driving indicators, Josh. Like you had started saying, inflation has been the main thing we've been hearing about the past few years. So on your screen, you can see where inflation is at, and you can see middle of 2022, we peaked at 9.06% on the U.S. inflation rate, which is extremely high. Remember, their target rate is 2% for the Federal Reserve. We've now gotten it down to around 4%. And the orange line you can see in there are the Fed funds overnight rates. And you can see how mid-2022, early 2022, they had began increasing those rates, largely due because they're seeing this high inflation. Recently, and if you're keeping up with this, we've kind of been a broken record, right? It's been Fed raises rates 0.25%, Fed raises rates 0.25%. Well, guess what they did, Josh? They paused their rate raising, and they're seeing how that works into the system. They've seen inflation subsiding, but as you mentioned, there are still some sticky parts of the economy. Consumer spending remains very high, even though they have been trying to slow the economy down. And the other key driver here, and we find this very interesting, is the unemployment rate. So on your screen right now, you can see the orange line is the U.S. unemployment rate. That big spike you see is COVID-19, when a lot of people got laid off, lost their jobs, whether it be temporary or permanent. The green line you're seeing is the seasonally adjusted non-farms payroll. So this is the job openings for most Americans in the workforce. And what you can see is we have a 3.7% unemployment rate, which is extremely low compared to their bench. Right, they'd like it between 5 and 7, I would say, I believe. And the job openings are significantly higher, up in the 9%. What that's telling us is for every job opening or job seeker there's about 2 job openings.
So there's still room.
There's plenty of room. Now, there's one key thing that we're not taking into consideration, and this is very interesting. So during the pandemic, Americans received a lot of money into their balance sheets. Stimulus money, right? Now, if we look back and say, well, how is that money working in American bank accounts? Well, we have about 1 to 2 quarters until those reserves kind of run out, in theory.
Right.
You would think that that number would drive more Americans into the workforce to proactively seek employment. And what many economists are talking about is, as those funds in theory get spent, will we see a jump in job seekers into the market? So certainly some things going on in the economy that the Federal Reserve seems to be getting under wraps. We have seen inflation get cut in half, probably because of the increasing of the overnight lending rates, but we do have some sticky parts of the economy. So given what we've noted so far, and now we can focus on the second half of the year, it seems the improvement in the bond market and the positive returns, and we believe there's still plenty of opportunities for both capital appreciation and attractive income generation now that we have these higher interest rates, assuming both inflation and interest rates continue to glide lower.
That's a big assumption still.
That is a big assumption. We can call our friend Jerome and see where he and the FOMC are going to take this, but and as we believe. So for income-oriented investors, Josh, the bond market could offer an opportunity that has not existed in over 15 years. I know that we're getting a little salt and pepper here, but like that was kind of when we all started in the industry. So we haven't seen that ever. So that's very interesting. When we turn to stocks, the market has already put in some notable gains for the year, like Josh mentioned, some around 20%, 19% on the major indices. And with recession risks still looming, investors may consider less than aggressive models with their portfolios than they were the first half of the year. That doesn't mean that stocks can't go up from here, but the risk-reward equation for the stocks and bond is a little bit more balanced. So, Josh, I know we made some changes to our models here at Stein Wealth. Could you talk about that a little bit and some of the other implications from all of this economic data coming out?
Yeah, and everybody's portfolio is different, but some of the key areas that we have addressed is we've taken a little bit of risk off of equities and actually added a small cash position to the portfolio, just kind of like what you said before with regards to we've seen an increase in stocks and maybe it's never a bad idea to have a little bit of opportunity in our back pocket if we do see some continued volatility. We've also increased our bond position, so we've held some alternatives that have helped ease the volatility in the bond market, and like I had mentioned before, we've seen a significant amount of added stability back to the bond market. So we've been buying them up, and so we've kind of increased our bond positions, we've lowered our equities just a small amount, and really moved more towards quality, which I think is helpful given the fact that we've seen some market increases. Because see, really the key issue here is still recession, and we've seen a push for lower corporate earnings expectations, some weakening in some of the very key areas like manufacturing and service indicators. Those can be early signs that consumers are slowing down. Maybe that goes back to kind of what you said about some of that stimulus money kind of finally running out. That could point to the likelihood of a mild recession. I want to emphasize the word mild because we do truly believe that we may be entering still a recessionary period, but the expectation would be that it would be significantly more mild than some of the worse and bigger recessions we've seen, because we've already felt a lot of that pain. And that's reinforced again also by what you were speaking of with regards to the job markets and whether or not they continue to potentially get weakened through the end of the year. But overall, the opportunities in the second half of the year may not be quite as robust as what we've seen thus far in the first half. But after a bumpy 2022, we really feel reasonably encouraged that continuing to be in the stock market should bear some fruits in the coming months. In fact, I think the difficulties of what we witnessed last year really helps lay the groundwork for future market stabilizations for the long haul and as we press ahead. And despite our, what I would say, mild market recession outlook, we still truly believe that there are definitive investment opportunities to uncover, and we stick to our key fundamentals and we stick to our core beliefs on how we manage portfolios, and we hope to expect to uncover those opportunities moving forward. So thank you for your time, and as always, if you have questions that this video has brought to your attention, please feel free to reach out to us directly, and we're happy to elaborate further. So thank you, Joe, and thank you to all of our clients and everybody who trusts us for important information.
Thanks. See you later.
Bye-bye.